Well, good morning, everyone. My name is Rich Galzarano, and I'm a financial advisor with 21st Century Financial. I will be presenting today with my colleague, Judy Ramsey, who is also an advisor with our firm. We would also like to thank Brady Ware, who did a great job on the first part of our presentation, which covered the important CARES Act provisions for small businesses. Today, we'll be covering the second part of our presentation on the CARES Act. And if you were wondering, it stands for Coronavirus Aid, Relief, and Economic Security Act. There will be a quiz at the end of this to see if anyone can actually remember the name of the acronym.
And if you do, you get a free lollipop.
Right. All joking aside, there are a lot of acronyms that the government has created for this CARES Act. So we'll be sharing with you some of the additional acronyms that the government has added to this. So to continue, the CARES Act, which was passed on March the 27th, has over 800 pages worth of legislation that impacts almost every American. It is the largest stimulus package in American history. Our goal is to provide you with some valuable information today so that you can make better and more informed financial decisions for you and your family. If you have questions, please type them in the chat box. We will try to answer a few questions live if time permits. And if we don't have an opportunity to answer your question live, we will most certainly answer your question via email. So our email, we'll provide our personal emails at the end of this presentation. And also you can do it to our general email inbox, which is info@xxiadvisors.com. That email is included on the registration. So moving on to the next slide. Yes, this is our disclaimer here. So, as a best practice, we always recommend that you consult with your own independent legal and tax advisors when you're making an important financial decision. If you need our guidance to help find the right team, we'll be glad to help. So here's some of the topics that we'll be covering today. First of all, we'll do a brief overview of the CARES Act, and then we're going to get into stimulus checks and the rebates. Next, we're going to cover income tax filing and some of the payment extensions that the government has enacted, followed by some student loan options that are available within the CARES Act. And then we'll move on to mortgage provisions, particularly on the topic of forbearance, which is included in the CARES Act. Next, we'll cover retirement plan updates, and that will be particularly on qualified plan withdrawals and required minimum distributions for retirees. Next, we will also cover unemployment benefit updates. And then last, to finish it off, we will give you some guidance on individual health plans as it pertains to COVID-19, as well as some charitable donation updates. So the CARES Act is a $2 trillion stimulus. And as I mentioned, it is the largest stimulus package in American history. We're going to focus on two main areas of the CARES Act today. The first one is on individuals, families, and businesses. And that represents 28% of the CARES Act at $560 billion. And then the next piece of it is the education piece. And we're just going to cover one portion of that, which is the student loan piece of it. And that represents 2% of the total cost of the CARES Act, which is $44 billion. So next, I'm going to turn it over to Judy, who's going to talk about the stimulus checks.
So thanks, Rich. So this is kind of a busy slide, and I apologize for this, but nothing is simple when the government enacts anything. So this, like everything else that the government does, is a little bit cumbersome. So first, I want to say that most of you don't have to do anything, that stimulus checks will be sent automatically. Probably a lot of you have already received your payments, and we'll be talking about, if you haven't, what to do. They're in a couple slides, so I'll share that with you. What I'm going to do is kind of go through the individual section on this slide, and then on the next slide, we'll go through an actual example of a married filing jointly kind of example. So if you look on the first kind of row that goes across where it says individuals on the left, again, this is based on 2019 tax returns. And if you haven't filed your return, it will be based on 2018 tax return. So for an individual making less than $75,000 of adjusted gross income, that individual gets a $1,200 rebate check. If that individual has a child who is under the age of 17 with a valid Social Security number, that individual will get an additional $500. So in total, they would get the $1,200 for themselves, $500 for each child. If they had one child, they'd get a total of $1,700. So it gets a little bit more complicated after this. So if the individual makes more than $99,000, they get nothing for themselves. And for the child, it varies based on their income. So there's not a set amount. But if they make between the 75,000 and 99,000, that's when it gets a little bit more complicated. So they start off with the $1,200 for themselves. And for every dollar that's over the $75,000, the $1,200 gets reduced by 5% of that. So I'll translate that for you because that gets complicated. So example, so an individual makes $85,000. Well, they're $10,000 over the $75,000 limit. So they take the $10,000, 5% of that is $500. So they get the $1,200 minus $500. So they get $700 for themselves and $500 for each individual child under 17 with a valid Social Security number. So on the next slide, I'm going to show you something, but Rich, can you go back for just a second? Yeah, thanks. So I want to point this out so that if you want to get more information or find out more details, there's a website that's noted at the bottom, the www.irs.gov/corona tax relief and economic impact payments. If you go to that website, that will give more details on that. So go ahead and switch now, Rich. So this is an example, another example. This is David and Andrea Miller. They haven't yet filed their 2019 taxes. So if we look at their 2018 taxes, their household income in 2018, their adjusted gross income was $170,000. So for David and Andrea, they're married filing jointly. They each are entitled to that $1,200 base amount, but they make over $150,000. So we take the difference between the $170,000 and $150,000, that's $20,000, and multiply it by 5%. And that's the amount of the reduction from the $2,400. So they get the $2,400 base less the $1,000. So for the two of them, they get $1,400. Now they have 3 children, Jim, who's age 12, Sabrina, who's age 14, and Tom, who's age 17. So for Jim and Sabrina, they get $500 each. But since Tom is age 17, and remember we said for any child under age 17 with a valid Social Security number, there's $500 a piece. But since Jim is actually 17 already, they get nothing for that. So the total is the $1,400 for the two of them, plus the $500 for Jim, $500 for Sabrina, and the total is $2,400. So one thing that is important is that if you do not have a valid Social Security number, you will be excluded from this, from the rebates. And many Americans who are living in Puerto Rico and some of the other US territories are also excluded. You'll note at the bottom of this slide, if you want to kind of go through your own scenario, if you haven't yet gotten your check, there's a calculator at kiplinger.com that you can see what your rebate check would be. There's lots of other calculators too if you just Google, but that's one that you have as an example. So Rich, you want to go ahead and flip to the next slide? Thanks. So if you have not yet gotten your payment and you want to check the status of your payment, you can go to the website noted there, the www.irs.gov, the coronavirus Get My Payment check site. And if you haven't filed your taxes or the IRS doesn't have your information, so for example, for veteran, if you're a veteran and you're on veterans retirement, or if you're getting disability or survivor benefits and you've not been claimed as a dependent on someone else's check, then, or on someone else's tax return, then you can go to the website noted there. Okay, Rich, next slide. So that kind of wraps up the stimulus checks. I think most people are aware of this at this point in time, but we just wanted to make sure that everybody knows about tax filings and payment extensions. So for the federal, for your federal taxes, 2019 tax filings, the deadline has been extended to July 15th, 2020. In addition, the tax payment for Q1 of 2020, estimated taxes, that has been extended to July 15th, 2020 as well. On state income taxes, it varies by states, but many states, including Ohio, has extended the deadlines to be exactly the same as the federal. So both for 2019 filing and for 2020 Q1 estimates. And then the locals, there was a lot of scrambling that was going on at the local level. It's really best to check with your local municipality to find out if the deadlines have been extended. And you can just Google that and you'll be able to get that information. So I'm going to hand it back to you, Rich, to talk about mortgage options.
Thank you, Judy. I'm going to start with student loans and then I'll get on to mortgages. So student loans, there are currently $1.6 trillion in outstanding student loan debt, and an estimated 44 million Americans have student loans. So, most provisions of the CARES Act pertain to really the specific loans. They're direct loans from the federal government and federal family education loans. So there are some loans that are not included within the language of the act, and I'll get to those and some of my slides. So here are some of the key points if you have a student loan. The first important key point is that loan payments are going to be suspended. That started on March 13th, and they're suspended until September 30th of 2020 for certain federal loans. Specifically, this applies to non-defaulted direct loans and federal family education loans currently owned by the Department of Education. In addition, loan servicers were advised to auto stop the debits that are coming out of your account. And they were given a deadline by the government to have that completed by April the 10th. One thing to note is that if you are financially capable of making any payments for your student loans during the suspension period, all of your payments will be applied directly to principal. And that comes on to my next point, the interest waiver. Interest will not accrue while loan payments are suspended. There will also be no penalties or late fees for any non-payment of your student loan. In addition, your credit report, any suspended payments will be treated as if you made a regularly scheduled payment. Moving on to loan forgiveness. If you are seeking loan forgiveness through the Public Service Loan Forgiveness Program, the suspension of the loan will count towards that forgiveness as if you were making your regularly scheduled payments. In addition, there are other repayment plans. The other one that is well known as the income-driven repayment plan. That also applies. The suspension period can be counted as qualifying payments, and that can be applied towards your 10-year qualification period. Next, we come on to defaulted loans. If your loan is in default, the Department of Education is suspending any involuntary collection of loans that were in default. So that would include if your loan was defaulted and they had garnished your wages, withheld Social Security, they had withheld your tax refund, or any other federal benefit offsets. The following loans are not eligible under the CARES Act. There's some Perkins loans, and there are also some federal family education loans, and private loans are also not eligible. It is estimated that at least 9 million borrowers have at least one loan that is not covered by the Act. If you have a student loan and you haven't already done so, I would recommend contacting your servicer to determine what type of student loan that you have to check eligibility. The good news is that your servicer was directed to stop your auto payments. Next, we're going to move on to mortgage options, and particularly forbearance. So the CARES Act has implemented an option called forbearance, and this is designed that if you're currently experiencing financial difficulty due to the coronavirus, forbearance could be an option for you and your family. Forbearance can help consumers get back on their feet during this short-term financial difficulty. But there are a few things that you need to know and some important decisions that you're going to need to make. Forbearance, what it truly means is when your mortgage servicer or your lender, that's the company that sends you the mortgage statement and manages your loan, allows you to pause or reduce your payments for a limited period of time. Forbearance does not erase what you owe. You will have to pay back any missed or reduced payments in the future. So if you're able to keep up with your payments, I would keep making them if you have the financial capability to do that. So there are different types of forbearance available by loan type. If your mortgage is backed by the federal government, this would include FHA loans, VA loans, USDA loans, Fannie Mae, and Freddie Mac loans. Those are all included within the CARES Act. They have allowed you to temporarily suspend payments. Loan servicers are also giving you forbearance options for non-government backed private loans, but every servicer is different in what they are offering to you. So if you don't have a federal loan, you still may be eligible for this. However, you're going to need to reach out to your service provider to see what options are available to you. So here's how it works for federally backed mortgages under the CARES Act. If you are experiencing financial hardship, you have the right to request forbearance for up to 180 days. If you need it beyond that 180 days, you have the ability to request an extension for an additional 180 days. But you must contact your servicer to initiate the forbearance period. It's also important to really understand that this is not a forgiveness program. However, the mortgage servicer cannot add any additional fees, penalties, or interest added to your account. During this forbearance period, your regular mortgage interest will still accrue. Other than telling your servicer that you have a pandemic-related financial hardship, you won't need to submit any additional documentation to qualify for forbearance. It's important to find out what options are available to you. The best place to find that information is from your loan servicer. Look for their contact info on your monthly mortgage statement. Regardless of the type of mortgage you have or how you communicate with your servicer, here are some things to consider. If you decide to move forward with a forbearance plan, ask your servicer how you will be required to pay back the amount owed after the forbearance period. That's very important. And also, will you owe the entire unpaid amount in a lump sum once the pause period is ended or at the end of the loan term? This is called a balloon payment. And a balloon payment is obviously not the best option. So you want to make sure that when you're talking to your servicer that would not be the option that they would be offering. In addition, the other question you'd want to ask is, can the loan term be extended so that missed payments are added to the end of your mortgage? Also, will your subsequent monthly payments be higher for a period of time to make up the deferred amount? One of the great resources that I looked at for this is the Consumer Financial Protection Bureau. And they recommend that when you are calling your servicer, that you get an agreement in writing up front so that you are on the same page with your lender. It's very important that you have a plan in place and that you know what is going to happen at the end of the forbearance period. Some other alternatives that are available to you. I just want to note that these alternatives are not included within the CARES Act. The first alternative would be the mortgage loan modification. A loan modification just would be a permanent change in the overall details of your mortgage. This would be adjusting your interest rate or extending the length of your loan or taking the amount that you owed during the forbearance period and adding it to the end of your loan. So I would work with your provider to see if a loan modification is an option to see if that's a good fit for you. And then lastly, another alternative would be to do a refinance, but that would just mean that you'd have to add your financial situation. You have to be in a financial situation to do that. All right, so that covers the mortgage options. Turn it over to you, Judy.
Okay, thanks, Rich.
Mm-hmm.
So many families have very little in the way of savings. And if they do have savings, those savings are oftentimes in retirement accounts. And given what's going on with COVID-19 and people being unemployed, many people don't have a lot to draw on other than unemployment that they'll be getting, and Rich will talk about that in a couple slides. But the government wanted to make sure that people had access to some funds. So they changed some of the retirement plan rules. I would caution everyone that if they're planning to take advantage of some of the changes that are outlined here, that they make sure that they understand the impact of that on their retirement plans, because obviously they've been putting money in their 401k or IRA to save for retirement. And if they're choosing to withdraw from that, it's going to impact their later life as well. So would urge you to talk with both your CPA and or your financial advisor before you take advantage of this option. So for 2020, the required minimum distribution is waived. So if you're beyond the age of 70 and a half now, you have to take required minimum distributions normally. For 2020, that requirement has been some of the changes in terms of the rules or the relaxing of the rules are the next couple things. So now everyone, regardless of their age, can withdraw up to $100,000 from their 401k or IRA. And if you are under the age of 59 and a half, there will be no 10% penalty for that withdrawal. So normally, if you withdraw from your 401k and you're below the age of 59 and a half, there's a 10% penalty automatically on that money. For 2020, that will not be the case. If you withdraw up to $100,000, the taxes can be spread over 3 years. So if you're withdrawing money from your 401k, it has not been taxed yet, and you will owe taxes on it. That doesn't change. Normally, what would happen is that you have to pay taxes in the year in which the withdrawal is made. So for this year, what they're doing is extending that tax payment over a period of 3 years. So for example, you could pay a third of the taxes this year for the tax filing year 2020, a third of the taxes for the tax filing year 2021, and a third of the taxes for the tax filing year 2022. You can also spread it unevenly over the 3 years. So again, for tax planning purposes, that may be something that some people will want to use the option of. The withdrawals that you make can be recontributed back to the 401k. So another option, aside from just withdrawing from the 401k or IRA, is to actually just borrow against your 401k an amount that's equal to the lesser of the $100,000 or 100% of your vested balance. So if you have, say, $50,000 that is vested in your 401k, then you can withdraw up to the 50,000 as opposed to the 100,000. And since you're borrowing that money, it's not taxed. So in some ways, it may be a better option to borrow that money. Again, still would advise that you talk with your financial advisor, because you're borrowing that money. It's not going to be in there you're not going to be earning anything on it. So just want to be careful in terms of the strategy that you use in making sure that you're minimizing the impact to your future retirement. The other thing, if you are borrowing money from your 401k, the repayment of the loan is normally started at the time of the month following or in the year in which the withdrawal or the borrowing is made. But for purposes of the CARE Act, that repayment doesn't start until 2021. So, Rich, if you could go to the next slide. One very important thing is to know that everybody can't just borrow from their 401k. There are certain restrictions that have to be met, so that it must be related to the coronavirus. So meaning that you either have to have been diagnosed with coronavirus, you have to be caring for a spouse or a child or other dependent who's been diagnosed with COVID-19, or the next one is kind of the big one that everybody's affected by, or most everybody, that you are financially impacted by the stay-at-home mandates, or being furloughed, or your hours are being reduced, or you're laid off, or you're not working because you don't have childcare. So most everybody has been affected by that. So most everybody might be eligible for those options. But it's important to know that you have to be able to demonstrate that it's a result of the coronavirus related criteria. So I'm going to hand it back to you, Rich.
All right, thank you, Judy. All right, so the next topic we are going to go over is unemployment. And, the statistics I'm going to share with you are not fun to talk about. However, it is reality. And I am thankful that our government has taken action to help people that are unable to work receive benefits. So just as of April 18th, according to the Department of Labor, there's a total of 26.5 million people that have applied for unemployment benefits since the pandemic began. And prior to that, there were already over 7 million people unemployed. And that represents about 20% of our workforce, which is the highest unemployment rate that we've seen since the Great Depression. To help all of those Americans that are unemployed during this crisis, the CARES Act has included some key unemployment benefit changes for unemployed workers that are eligible. So the first one is the Pandemic Unemployment Assistance. And again, we have another acronym here, PUA, and I'll just refer to it as PUA so I don't have to continue to say that tongue twister over and over again. So what the PUA does is it expands unemployment coverage to specific workers that were traditionally not eligible for unemployment benefits under their state law. And that includes some self-employed, independent contractors, those that do not have a long work history, and then also those that had exhausted their benefits prior. A couple of examples of those that are not eligible for the PUA benefits. If you are able to telework for pay, if you are also receiving paid sick leave or any other paid leave benefits, that would exclude you from this assistance. Also, the PUA is providing a maximum of 39 weeks of benefits that started retroactively on January the 27th of 2020, and then is extending all the way until the end of December of 2020. These weekly PUA benefits will equal the weekly benefit that you would otherwise receive under your state law, plus potentially an additional $600 weekly benefit under the, again, another acronym, Federal Pandemic Unemployment Compensation. And that is through the federal government. And that compensation period goes up until July the 31st. These PUA benefits will not be subject to any type of waiting period. If you've experienced that before, even if your state has a imposed waiting period, these will not be eligible. These will not be eligible for a waiting period. A couple resources that I found helpful to help guide you. The first one is for the state of Ohio, and that is unemploymenthelp.ohio.gov. The nice thing about this is that if you are not sure if you're eligible for unemployment, they will ask you a series of questions on there if you're an independent contractor or self-employed to see if you are eligible for benefits. Because one circumstance could be you may not be eligible for state benefits. However, you might be eligible for federal benefits. So I would urge you to go on there if you are not entirely sure whether or not you're eligible. If you do not live in the state of Ohio, this is a great website. This is a Department of Labor website, dol.gov, and then you've got coronavirus / unemployment insurance. That's a good site to find or to look at just to find your state guidance on unemployment benefits. The next is a slide that just overviews all of the guidelines to be able to collect unemployment assistance. And again, much like Judy had shared about retirement plans, there are several key factors that you would have to at least qualify for one of these. And many Americans have been impacted in one way, shape, or form by this pandemic. So many of them revolve around if you've been diagnosed with COVID or a family member has been diagnosed If you have a, primary caregiver or a childhood member that's been unable to attend school due to the pandemic, unable to go to your job due to being quarantined, or you were advised by a medical provider to self-quarantine during this time. Also, if you're going to start a new job and that was supposed to start, but that got suspended due to the pandemic. If you became a major support of your household due to an unfortunate passing of a family member, or you were forced to quit a job because you had to take care of your children or something else had happened. And then lastly, if your place of employment closed. So these are some of the situational guidelines to help you understand who would apply for this and who wouldn't. The next piece of this is the Federal Pandemic Unemployment Compensation, FPUC. And FPUC is, if you're eligible for unemployment benefits, you will receive an extra $600 weekly for all weeks of unemployment between April the 5th, and that extends until the end of July. This is in addition to your state unemployment benefits. This benefit is taxable. However, it will be disregarded for purposes of determining eligibility for Medicaid and the Children's Health Insurance Program. And then lastly, the Pandemic Unemployment Emergency Compensation, PUEC. State unemployment benefits are extended for 13 weeks. Typically, unemployment caps out at 26 weeks, but they've extended that period to 39 weeks. These benefits are available through the end of December. If your unemployment benefits, if you were previously unemployed and they had exhausted at some point after July of last year, then you will have the ability to reapply for unemployment and receive these extra 13 weeks that they've added. Any extended benefit weeks received prior to July 30th will receive the additional $600 weekly benefit under the FPUC program. So that covers unemployment, and I'm going to pass it on to Judy.
Thanks again, Rich. So another impact of the crisis is the cost of healthcare should you contract the virus, or one of your family members contract the virus or need testing. And that obviously could be pretty substantial. So that was something else that is covered in the CARES Act. So most carriers are waiving the cost sharing, that being cost sharing meaning the deductibles or the copays, and most of us have those. So whether it's the copays or the deductibles, or even if you don't have it, have coverage, there is provision in the CARES Act to cover the cost of both testing and treatment, both in and out of network, as well as the cost of the provider visit. So it's really the whole bundle of services that are related to COVID-19. The best way to find out about that is to actually talk with your healthcare provider or your healthcare insurance company to find out. Also, many physicians are providing telehealth and other alternatives. So there's lots of ways that you can continue to get care, and all of those services are available to you from most carriers at no charge. So again, check with your individual insurance company to find out. And the last piece that we're going to talk about, Rich, if you'd go ahead and continue to the next slide, is charitable contributions. So you all probably remember that a couple of years ago, the tax laws were changed and the standard deduction was increased substantially, so that most of us don't itemize our deductions anymore. We just take the standard deduction. And when that happened, one of the deductions that went away for many people was the charitable donation deduction. So in order to encourage people to make charitable distributions on a cash basis, this provision was enacted as part of the CARES Act. So for everybody, so even for those people who don't itemize their deductions, they will get a $300 charitable deduction for any 2020 cash gifts. So it's important that those are cash, to note that those are cash gifts. In addition, for those people who do itemize, after all the other deductions are calculated, the contribution limit for 2020 is raised to 100% of the gross income, adjusted gross income. Used to be, it has been and will be in the future, 60%, but that is raised to 100%. And the last thing, just wanted to note, Rich, if you'll go on to the next slide, is just a list of all the sources that we've used. We've alluded to those in our presentation today, and there's just a listing of those resources. And actually the last thing is that we wanted to thank you very much for your attendance today. We hope that this has been helpful for you and has given you some additional information and sources of information, resources that you can go to. My email address and Rich's email address are on this slide. Rich alluded to the info@xxiadvisors.com email address as well if you have questions. And I think we have a little bit of time. I know there's a couple of questions in the chat box. One, Kim asked, did you say that why they did not include 17 to 18-year-olds in the act? And I don't know what the reasoning was behind that. I don't know if you do, Rich, but I do know that that was the cutoff age. I'm not sure why. Rich, do you know anything?
Yeah, I can't give you a logical explanation. There are some holes in the CARES Act. I mean,
there's a lot of holes in the CARES Act.
Yeah, I mean, I think they were very, there's a sense of urgency to get out stimulus to the Americans, just just to help people stay on their feet. I don't think that I don't know where the reasoning was when they came up with the 17-year-old criteria, because I do know, Kim, that there are a lot of kids that are still in the household that stay well beyond the 17.
And
so
they're being,
I don't know how they cut that off. I wish I could give you an answer on that.
And they're being declared as dependents on people's taxes. So
sure.
Yeah. So another question was whether people should be saving or putting something aside to pay for taxes on unemployment.
I think that would be a best practice because it is taxable.
It is taxable.
I would agree with you, Kim, that that would be a best practice to set aside money, because you will owe taxes on your unemployment income. I would work with your CPA, if you have a CPA, to determine what might be the right amount, what the right percentage based on your past tax returns. If you don't have a CPA, then utilize. Brady Ware was one of our partners, and we'd be glad to introduce you to them.
Yeah. And the other question from Lynette is, did we say if self-employed persons are eligible for the stimulus check? And the answer to that is yes. Everyone is with a valid social security number is available or is eligible for the stimulus. Again, depending on their income, it's best to go to the two websites that we mentioned to determine that, but it's based on your tax returns. So whether you're self-employed or employed by someone else.
And thank you, Sherry, for the kind words. We will be sharing a recording of this webinar to the attendees. And also thank you, Kim. We'd be glad to share Brady Ware's info for you so they can give you some guidance on that. And thank you, Lynette. Hope you, I know some of this information is not the most exciting in the world to talk about. However, we tried to make it as concise as possible. It's an 800-page bill. If you read it, the bill in its entirety, you're going to need some Red Bull and some coffee and
or a hefty glass of wine
and an intervention after. But thank you, Melissa. Thank you, Lynette. Thank you all, everyone that's commented, and thank you for attending our call.
And please reach out if you have questions. We'll be happy to answer them.
Yep, absolutely. So, all right. Having said that, we're going to close out the call, and everyone have a wonderful day.